All right, for the next few minutes, we're going to get inside the mind of a senior oil trading desk head. We're going to talk about what they are truly accountable for. And I can pretty much guarantee it is not what you think it is. This isn't about chasing a big P&L number. No. This is about survival, it's about governance, and it's about the kind of decisions that decide whether a desk lasts for a decade or becomes a cautionary tale inside of a year. Everything we're about to cover is built on one core principle: how oil desks actually operate under stress. This isn't textbook theory. We are focused entirely on the messy reality of making decisions when the markets are dislocating and, frankly, when survival is on the line. And that brings us right to the foundation. We are now in Chapter 1, what an oil trading desk is accountable for. If you get this wrong, I promise you, nothing else you do is going to matter. So if you ask anyone on the street, you could even ask a junior trader what a desk is for, you'll get this answer. An oil desk is accountable for making money. It seems obvious, right? It feels right. But I'm telling you, at a senior level, this is the first and most dangerous misunderstanding that you have to eliminate. Yes, a desk has to be profitable, of course, but profit is an outcome. It's not the mandate. Chasing P&L above all else is the fastest way I have ever seen to blow up a desk, to end a career, and to destroy a firm's capital. The real mandate, the job itself, is a constant balancing act across these 5 accountabilities. Number 1, sure, it's returns, but they have to be risk-adjusted returns. The other 4, they're all about survival, preserving your capital, maintaining operational integrity, making sure you can survive regulatory scrutiny, and containing any reputational damage. Any desk that over-optimizes for just one of these at the expense of the others is on a countdown to failure. It's just a matter of when. And this slide shows you exactly why a raw P&L number is just a vanity metric. I mean, look at Desk A. $200 million. Looks fantastic on a spreadsheet, right? But underneath it is a ticking time bomb of hidden basis risk, uncollateralized credit, and exit strategies that require a perfectly normal market. Now look at Desk B. $80 million. It's cleaner, it's controlled, it's capital efficient. Which one is a sustainable business and which one is just a gamble? As a senior manager, I will take Desk B every single time, no question. So when you walk into a risk committee meeting, believe me, no one is just staring at the P&L number. The board, they're asking, is this durable? Can we do this again next quarter? The risk managers, they are obsessed with the downside asymmetry. They want to know, how much can we possibly lose if this all goes wrong versus what we stand to gain? And the CFO is looking at capital efficiency. How much of our balance sheet are you eating up to generate this return? And let me be perfectly clear. Desks don't die from getting the price of Brent or WTI wrong. That's not what kills them. They die from the things that don't show up neatly in a VAR model. They die from basis risk, that difference between 2 related prices, blowing out unexpectedly. They die from liquidity just evaporating the exact moment they need it most. From a simple operational delay on a single cargo. From a sudden massive margin call from their clearer. These are the silent assassins in the system. This is a line I have lived by for 20 years. If your worst-case scenario for getting out of a bad position requires normal liquidity, you do not have a scenario. By definition, a real stress event means liquidity is gone. Assuming you can sell whenever you need to isn't risk management, it's a prayer, and we don't get paid to pray. Let's talk about capital for a second, because this is where the theory of a trade smacks right into the reality of the balance sheet. You know, every single barrel you store has to be financed. Every futures position requires margin that can change dramatically overnight. Every physical cargo chain ties up huge amounts of working capital. Capital is finite, and in a crisis, it is the only thing that actually matters. Now, just look at these 2 cases. The EU desk, they had a great idea, a profitable contango strategy, where future prices are higher than current ones. Looked great. But then their financing costs blew out, the Treasury Department pulled their funding line, and they were forced to liquidate their entire position into a weak market. They turned a winning idea into a very real loss. The U.S. desk, on the other hand, explicitly tied their position size directly to their available balance sheet. Yeah, they made less on paper, but they survived. And in this business, survival is the only mandate that counts. All right, next up, reputation. This is an invisible asset, but it is as real as cash in the bank. It's what gets you access to credit, it's what gets you better pricing, and it's what gets you the benefit of the doubt from your counterparties. If your desk starts missing deliveries, or fighting over contracts, or just acting unethically, the market will quietly shut you out. And that access, once it's gone, is almost impossible to get back. And finally, there's regulatory survivability. It doesn't matter if you're in the EU under MAR and REMIT, or you're in the US facing the CFTC and the DOJ. The senior mindset has to be exactly the same. You have to assume that every single trade, every email, and every chat message you send might one day be reviewed by regulators with perfect hindsight and full subpoena power. You have to trade clean, always. There's no other way. These accountabilities also feel very different depending on what seat you're in. On a financial or paper desk, failure is fast and it's visible. A bad position hits your P&L in real time. Boom. But on a physical desk, failure is slow. It's insidious. A problem in the logistics chain, a credit issue with a counterparty, these things might not show up for weeks, but when they do, they can be just as fatal. Physical desks fail operationally first, and then they fail financially. Similarly, the whole mandate of the desk changes. If you're on an asset-backed desk for, say, a refinery, your job is margin protection and risk reduction. That's it. If you're on a pure portfolio desk, it's all about capital efficiency and controlling your drawdowns. Confusing these two mandates is a classic management error that always leads to disaster. So if it's not one big bad trade that kills a desk, then what is it? What is the slow-moving cancer that inevitably brings down even the most profitable operations? It's this pattern, and I've seen it a dozen times. It starts with a good run of P&L, which breeds overconfidence. Then the risk limits get stretched, just temporarily, to put on one more big trade. Everyone starts assuming liquidity will always be there to get them out. Then the market regime shifts. The exit you were counting on completely vanishes, and the losses cascade. It's a process of small, ignored governance breaches that accumulate into a catastrophe. And here's that lesson in two real-world cases. The EU desk saw the extreme volatility coming, and they stood aside. Yeah, their P&L was lower, but they survived with no stress, no forced liquidations, no credit issues. The US desk, they chased the mark-to-market P&L. They looked absolutely brilliant on paper until they got hit with massive margin calls. The cost of actually getting out of their profitable position wiped out every single dollar of profit and then some. The desk was shut down. Mark-to-market is an illusion if you can't turn it into cash. This is the key takeaway from that EU case, and it's one of the most important lessons in all of trading. Sometimes the most profitable decision you can possibly make is to do nothing at all. Risk avoided is capital earned, because it's capital you get to keep to fight another day in a better, clearer market. And this brings us to a core senior mandate: the right not to trade. Standing aside is not a passive act. It is an active, defensible risk management decision. A well-run desk has crystal clear rules for who has the authority to cut risk and halt all trading, especially when the models are screaming buy, but your gut is telling you something is deeply wrong. Your ETRM system is absolutely central to all of this. At a senior level, it is not a reporting tool, it is an accountability system. Its job is to make risk visible and to enforce control so that those small breaches can't accumulate silently in some trader's spreadsheet. If your traders are living in Excel, your governance is already broken. Full stop. So as a desk head, you have to ask a completely different set of questions about P&L. Not just how much did we make, but can this profit survive a real market stress? Is it repeatable, or was it just plain luck? And here's the ultimate test. Would I be comfortable getting on a stand and defending this position and all its risks under oath? If the answer to that last one is no, the position is too big. So let's summarize Chapter 1. A desk is accountable for these 5 things, all working together. The desks that don't get this, they look very successful for a while, and then they fail spectacularly. The desks that internalize this, they trade less, they survive longer, and they quietly compound their capital over years. They're the ones still standing after the storm passes. And that leaves us with a final question to consider, one that every senior manager has to be able to answer. When would you shut down a profitable oil desk? The answer lies in everything we've just discussed. Now that we understand a desk's true accountabilities and how they break under stress, the next chapter will dive into the critical differences between physical and financial trading desks, and how misaligning risk and talent in those seats is one of the most common and costly mistakes in the entire industry.